Welcome back, everyone, to Vox Markets. My name is Paul, and I'm delighted again to be able to speak to Dan Hanbury of River and Mercantile, one of the finest and, after his holiday, most tanned small and mid-cap investors. So welcome, Dan.
Thanks, Paul. Great introduction. Thank you very much.
Well, last week we had Freedom Day, and that was supposed to provide a big lift to the markets. Instead, we got a bit of a sell-off, and the 10-year, well, the yield on the 10-year Treasury is now around about 1.3%. There seems to be a sort of like a pull and tug between the sort of the equity investors and bond investors. Who's actually right, and what's your view on equities going forward?
Yeah, you're absolutely right. I mean, we're getting pulled around all over the place, aren't we? First of all, you've had that massive fiscal stimulus last year continued, and I think one of the big questions is how long does that keep being applied? And I think if you learn from history, it typically isn't temporary. It tends to, a lot of it gets left almost in a permanent fixture. You've clearly got very loose monetary policy still, and so we've had this amazing move from the lows of the pandemic crisis in March last year. First of all, you had the bond markets move, then obviously the equity markets have rallied really nicely over the last 12 to 15 months. And I think, to some extent, it's travel and arrive, isn't it, with that pandemic news? I mean, clearly the pandemic is part of the picture now. I don't think it's everything driving markets. There's lots of other, big picture things like, productivity growth, for example, that are clearly really impacting bond markets still. So I think to some extent there's a bit of travel and arrive. And actually you've had, an economy that overall relatively locked down with all this stimulus to keep it going. As the economy picks up, I guess the market's going to look through to actually stimulus might be a bit less. So some asset prices may not do quite so well in that scenario. So you're probably going to get a bit of volatility coming in. And clearly the more richly valued markets like the US would certainly be vulnerable in that scenario. I think the nice thing about the UK market is that it's still trading at a very big discount versus other global equity markets and versus history. And people always point to the fact, well, actually, that's because there's lots of dull large cap stocks in the market. But of course, we know that down in the small and mid cap end, there's some really exciting opportunities still. So we're still positive on UK equities. Expect some volatility, I think, over the next few months would be my best guess. I wouldn't be surprised to see the market sell off, but that will also give us an opportunity to reload with some opportunities. And then the bond market, really interesting. I think you've got to read the sentiment, haven't you? And what we saw back
it's sort of saying to me, the bond market is sort of saying traditionally is that we're going to have an economic slowdown, and therefore the smart money goes into fixed income, saying that there's going to be some sort of problem with GDP and growth and stuff like that. But frankly, I actually think that rule book is broken this time. And the reason is there's so much QE and central bank buying of treasuries and gilts. Plus, you've got the pension funds driving the yields artificially down. And therefore, the economics actually are going to be, and they may not be massive, but the trends are going to be reasonable. So you could find that actually the distortions in the bond market are signaling different things to actually the economics, which most people would actually traditionally associate them to be, to have a really low yield.
I think that's absolutely right. Some of the rules, if we look back over the last few decades, the kind of classic business cycle rules aren't necessarily applying in quite the same way, are they? And that's to some extent been the case since the global financial crisis, but probably even more so now. You're right about the Fed have effectively cornered the market in treasuries, haven't they? If you look along the curve,
and the Bank of England in gilts.
Well, 25 to 30% of the market. In 10-year and 20-year, they own over 50% of the market. So you've got an incredibly distorted market with that big balance sheet. Same in the UK with the Bank of England. And I think, clearly it's in government's interest to hold yields low whilst they've got these enormous borrowings and let inflation run above that. And that's what they're clearly trying to do now. That seems to be the policy. They're going to try and run inflation hot. But it's not that easy to translate what looks like, as you said, there's a mix of structural inflation and transitory inflation. And one thing we're having to do as investors is try and pick out which is which, because what we saw back in sort of March, April time was a bit of a spike in inflation fears, which we've seen several times in the past, certainly through my investment career, when growth is picking up, inflation starts to pick up, bond yields pick up, and then actually you get this kind of big fear about inflation, which almost they overcook it. And so the lumber price is a great example, isn't it? Lumber price spiked very high. And it's now fallen 70%. So if you speculated in lumber back in March, April, you've lost 70% of your money. So
Bitcoin.
you've got to be really, you've got to be really, you might think, oh, it's a no-brainer to buy the inflation trade. You've got to be really careful of your timing and watching where people are getting overexcited in certain parts of the market.
Yeah.
So I think you're right. I don't have a strong view on bond yields on a 12-month view. I think it's entirely possible that having had that run up to 1.75% in US Treasuries now, then back to sort of 1.2. I think it's entirely possible they now push on again up to 2%.
Yeah, I'm with you. I'm with you. If you've basically got central bankers taking the foot off the gas in terms of QE and tapering, if they start tapering, which is essentially what might happen in Jackson Hole next month, then if they begin that process, then the artificial sort of dampening effect on yields, on the Treasury yield, is going to go up. And if you think about that, then we might get a repeat. The volatility you're talking about, that hyper growth, long duration assets, the Teslas of this world, the snowflakes, all that kind of stuff. You might see some wobbles going off on those type of assets, but do well for the traditional, more value GARP type tilt.
Yeah, absolutely. I think that's entirely possible. And when we think about blending our portfolio between more, let's call them reopening trades, cyclical value, or industrial trades with, some of those structural growth companies, I think what we're doing a little bit on the structural growth side now is we're making sure, even more so than before, that we've got real valuation discipline in there now. Yeah. And so we're tending to actually go back a little bit to some of what I call some of the high quality defensive names that have become really cheap. They've almost been left behind by those names. And so, in fact, on some measures, we see some of those more defensive, high quality names back at sort of almost, they're as cheap as they've been since 2012.
I would agree.
That's quite interesting. Whereas a lot of these growth stocks have stayed on the very high multiples, as you say. The Tesla is obviously an extreme one. But so I think you're right. I think we're certainly wary about those hyper growth stocks. I think there could easily be an accident in those stocks where there's a lot of crowding still in that area, particularly in retail money over in the States but also in the UK. And I think it doesn't take much for a bit of fear to trip with no fundamentals driving it. You don't need a fundamental catalyst. I mean, you could very quickly get a reversal in those names and people could come out quite quickly. But there's some great names, there's some great structural growth names as well. And so it's all about valuation discipline from our perspective in terms of how we blend. And we mustn't forget that there are still a number of those structural deflationary forces still at play. Admittedly, the inflation drivers now look a lot stronger than they were previously, but some of them are still there. There's not an obvious translation to wage inflation yet. I know I know there are pockets of wage inflation in certain industries, and you certainly talk to some companies, and they're talking about having to put the wages up to get
life sciences and technology in particular.
Yeah, life science tech, and obviously where there's supply constraints in reopening places like travel and leisure, for example, you're starting to see a bit there. But overall, if you look at the wage inflation, funnily enough, the UK has actually got the strongest. If I look at across the wage inflation data across the world at the moment, we've actually got some of the strongest. Although there is a technical aspect to that, it's something to do. It's the way it's being accounted for. It's what we include versus other people. So you got to be a little bit careful with the wage inflation. In the US, because you've had that strong CPI, you've actually had real wage inflation go negative in the last 3 months. That might surprise people. So people are very focused on that CPI number, but your real wage inflation has gone negative. That's not great. So you've got to, I do think you've got to look at both. It can't be just the headline metals prices going up, your bike and your holiday going. I think that there has to be that translation through to wage inflation ultimately, and that's where there's a bit of uncertainty on the timing because of the way capacity comes in and out. So we're not, certainly with our portfolio, I wouldn't say we're betting heavily one way or the other on that inflation deflation trade. We've got a reasonably balanced portfolio, and it's all about finding pockets of pricing power with your companies where they're going to be able to benefit from inflation or ongoing disinflation.
I think these underlying, though, I think you've got this sort of like disinflation put by central bankers, because it comes back to your point exactly. Politically, the acceptable solution is not deflation. None of the central bankers, you've had the ECB last week, you've had the Bank of England and the Fed all saying they're heading for 2% and to run the economy hotter. And there was a statistic which came out from the BBC yesterday saying that the national debt has now hit 100% of GDP, which if you add to the unfunded pension liabilities equates to £50,000 per baby, adult and or pensioner across the UK. So there's no way we're not going to get inflation. Even if we get deflation, they're just going to push the button, I think, is the answer.
Well, it's currency debasement, isn't it, to some extent? And you know, again, that's one of the part of the reason we still think an insurance policy in gold is the sensible way forward, and we actually have a number of gold stocks still in the portfolio, and you know, they do their job like they did during the sort of pandemic crisis. We took profits when they ran up very hard into the summer last year, but and they've been a bit of a laggard in the portfolio, you know, since we've had this big recovery. But we still hold them because actually, ultimately, if the market really gets, you know, a whiff of currency debasement, I think, you know, that's when your gold can really do a great job in the portfolio. So we're absolutely holding that as an insurance policy.
Yeah.
Again, not a strong view on it, but you've just got to keep managing these different tail risks all the time. So.
Yeah, and what about the actual, all these variants, the Delta variants, stuff like that? I mean, have we got the medical tools now to be able to get through this? And obviously, it's going to give us the short-term volatility as the world, you know, catches up as much essentially as the UK. But given we've got the vaccines are pretty good at stopping these new variants, or even like the Delta, for people going into hospitalisation, we've seen that in the data in the UK. And then likewise, we're going to get booster jabs in the autumn. So what's your view in terms of, we got the tools now to be able to reopen? And is the UK going to be using that blueprint for the rest of the world when it comes to reopening? As soon as you hit a good vaccination rate, hey, it's game on.
Yeah, I mean, you know, I'm generally pretty optimistic about the rate of innovation, particularly in the sort of healthcare science space, that's going to get on top of this eventually. But I guess one thing we've certainly found over the last 15 months or so, it's very easy to have disappointment along the way, isn't it, with these different waves, different cycles, different variants. So you know, one has to be a bit cautious about that. But you know, very interesting recent data with the latest Delta variant, isn't it? We've seen, even though at the start of opening up, we've clearly had what looks like a wave where things are dropping again. You know, we're down 40% from peak to the latest number yesterday, and that's with us opening up. Now, some scientists are saying, well, wait till the effects of the opening up. You've got that classic delay, you've got the incubation period, it's going to go again. But if I look back at India, which was horrific, quite frankly, I mean, they were underreporting cases and deaths over there significantly, and there was a pretty awful 6 or 8 weeks over there where a lot of people, you know, suffered, and the healthcare system just came under massive pressure. But even in India, you still had a big wave, and it was horrific for a bit, and then it fell away. And guess what? It's not in the news anymore. Yeah. And then that's what's quite interesting. You tend to get these natural waves. Now, some would say, well, actually, if we're not going to lock down, you're not going to get the same wave. It's not going to come off as quick if you're not going to lock down. If you keep the economy open, it's going to stay high. But the evidence, the most recent evidence, suggests you do still get these waves. The vaccinations are clearly having a big positive impact on those who've had them in terms of the suffering. Very few people getting hospitalized who've got vaccinations. I understand from a friend of mine who works in one of the large hospitals near here that the COVID ward is now full again. So that's not good to hear. One of the largest hospitals in Hampshire, and 75% of the patients are basically older people who've not had the vaccine.
Right, okay. And so it's unvaccinated.
Yeah, and the medical staff are not happy with them being there, I can tell you. There isn't the same level of sympathy maybe that there was the first time round, because
absolutely.
They're saying, why didn't you have the vaccine? Because actually it's nearly all the unvaccinated. And then there's about 25% of young people who maybe not had the opportunity. But I think it is still difficult. There's a lot of young people who are still vulnerable. You know, that we know there were the 1.5 million vulnerable people. So I have an awful lot of sympathy for people who still are concerned about it. You know, where there are children who are asthmatic, who are vulnerable. Yeah. There's still lots of nuances to this.
Agreed.
But I think if we go above that sort of micro level and look at the data and how it's going to impact the economy, I think the vaccines were incredible, weren't they? That science to bring those vaccines through so fast
and so good.
So good, so effective in terms of keeping people out of hospital. That gives me I'm sure you're the same. It gives me enormous hope about the incredible innovation that we can drive as human beings. And actually, I would hope that by the end of 2022, let's say that globally you've got on top of this, that you've actually rolled out enough vaccines to vulnerable people around the world, that you're largely now worrying about it as a kind of serious flu is what that's my hope and probably my central expectation. So that's obviously looking out now 18 months.
No, that's my view as well. I totally agree. And
I think that we've got to be ready for anything, but I'm reasonably hopeful that actually now, things will start getting back to get a bit more normal. I guess in the short term, my one slight fear is what happened last year as we came out of the summer holiday and into the school. Do you remember cases picked up in September, October, because all the children go back to school? It's quite hard to see how schools and policy are going to avoid that again. And we had to then lock down in October, November time, didn't we? And I'm hoping that because you've now got maybe more herd immunity because of all the vaccinations and things, that actually will avoid that this time. But there's still a little bit of uncertainty as we come out of the summer, isn't there, of quite how this plays out.
There's also in phase 3 trials, there's a number of sort of potential blockbuster therapeutics coming in. So if you get people in hospital there who haven't been vaccinated or refuse to be vaccinated, or alternatively have compromised immune systems or asthma and all that kind of stuff, then you hopefully be able to treat them. Anyway, whilst you were away, you had Christmas come early, didn't you? Because you've had a couple of nice, or 3 or 4 nice sort of takeover bids. So I did notice when we chatted last time, because we chatted about Ultra, which came out was being bid for by Cobham, and we've had Sumo as well over the last sort of 6 weeks, and likewise I think with Sigma Capital as well. So what's your view on the sort of the M&A? It seems to have gone absolutely nuts, given a lot of the that money, the monetary stimulus and the sort of the amounts of cash sitting on the sidelines.
Yeah, that's right. There's a huge amount of cash parked in a lot of it, whether it's within companies or within private equity looking for a home. We had the depressed period of IPOs and M&A through the sort of pandemic, and guess what? As things start to improve and the confidence returns, it is literally off to the races with the M&A and indeed the IPOs. Although I'd say on the IPOs, which we'll come on to, it's slightly more cautious there in the sense that some are doing very well, but not all. There's definitely, it's more selective now, I would say, in terms of what's doing well. But yeah, on the M&A front, obviously it's nice when you get big premiums on. Well,
you were spot on all those 3, particularly Ultra. I mean, that's a big cap effectively, but. You've picked up. It was about 60% premium to the undisturbed price.
In some ways, it could have been any one of 3 names, because we own Chemring and Kinetic in the sector as well. And our view is that the defence sector looked undervalued overall, and so we had bought essentially a basket. Now, Ultra Electronics is a name I've known for a long time. I remember modelling it as an industrials analyst back in the late 90s. It was one of the first companies I ever actually analysed. So, and I've seen it go through many cycles, but it had gone through a difficult cycle before we bought it. The organic growth had gone to 0 for 4 or 5 years. People were questioning the acquisition strategy. And then, of course, the new management came in and started to really push a self-help agenda.
Simon Price, isn't it, the CEO?
Simon Price, yes, right. And what I love about these businesses is the amount of innovation. If you think about in normal technology markets at the moment, you've got these amazing innovation wave we've had over the last 20, 25 years with tech and the digitization of the economy. We're starting on another massive innovation, which is the decarbonisation innovation wave that's now coming. You're going to see right across the economy now, you're going to have companies needing to try to decarbonise, and the way that plays through is going to be very interesting indeed. But I think the lovely thing about certain companies is where you see really strong innovation and R&D. And if you take Ultra Electronics, they were actually spending £150 million a year on R&D. Now you think, well, that can't be right. They're only a small company. But of course, most of it was funded by the customers. And this is the beauty of the defence. So about 120 million of that was funded by customers. They're only actually charging 30 million or so to their own P&L. So very innovative businesses that are constantly moving with the markets. And I think, for a Predator, seeing a company like that, where that innovation's going on under the bonnet, if they get their timing right, at some point they capitalize on all that innovation. In some ways, it's a shame to lose the company in terms of, but if they pay a decent premium, we're happy, right? And I think that was that looks like a decent premium that Cobham, obviously merging it with Cobham, which was taken out a few years ago. So that was great. That was
your view's the same actually to Simon's, because I did actually exchange emails with him, and he was obviously he'd come on for about 2 years, helped turn the business around with the rest of the management team, and they were making real traction about the like for like growth. So to get taken out is great for the shareholders, but I think for his management team, they were a bit sort of like the story hasn't yet run through yet, but. As you say, it's always good.
You always have mixed feelings, particularly. I mean, often for me, it's about whether what the CEO and C-suite, how they're really motivated. If I see a management team really motivated to go through with the transaction, I'm probably not going to want to get in the way, because actually it's all about the motivation of that top team at that point. And if we see other types of bid come in where maybe we can see that the CEO is less happy, we might, sort of stand in the way at that point. So I'd say with SUMO and Ultra Electronics, we've got very decent premiums there. SUMO, obviously a games developer. We've owned a suite of games developers for a number of years. It's a market we've really liked, where we think the forecast has been too low in the market. We've owned Team 17, we own Codemasters, which you'll recall was bid for in the autumn last year by Electronic Arts. And then we recently bought tinyBuild as an IPO in the spring to replace Codemasters. So we had that sort of basket. So now SUMO's gone out. We're still left with tinyBuild and Team 17. So really, these are really strong markets. And Tencent had already taken a stake. The big Chinese tech company had taken a stake in SUMO. I think they own 9 or 10%, and now they've actually bid for the whole company. Not unsurprising, actually. So yeah, no, as you say, it was a good week.
Yeah, you've done really well
in Devon. And then actually, just on price, though, I'd say the one where it was a really hard call as to whether we should, really accept the bid was Sigma Capital, which is a real estate investor. It's a specialist. They've been looking after a lot of the real estate in the PRS REIT. So the private rental sector is where they're expert, building homes in that space. Again, it was a decent premium. It was 30-35%, but we could see a lot of value there. And it was a really tight call in our mind as to whether we were getting enough value. In the end, we did our numbers, and we felt that actually it was a reasonable takeout price. So
pretty happy days.
Who knows what's coming next?
Yeah, exactly. Yeah, just on the IPO sort of side, I did say you deployed some of the capital into Moonpig earlier on, which obviously had done really, really well in the pandemic, as people have wanted to at least celebrate something, and therefore have gone to sort of like configure and tailor their own cards and gifts and stuff and get them sent online. So it's all COVID secure, but they haven't got to go outside the house or go down the retail, the actual shopping stall. So what's your view on sort of Moonpig going forward?
Yeah, we really like these consumer digital media type companies. I mean, if you think about Future PLC has been a favorite for, a lot of small cap investors over the years, where they've taken a consumer publishing business and turned it into a digitized e-commerce business. We've also got shares in Reach, which is the old Daily Mirror owner, again, who are digitizing their platform. And when you get these right, you can make an awful lot of money in these kind of shares. And we just see the same potential in Moonpig, actually. I mean, obviously it's going to get a slightly higher rating than those businesses were on originally. But, we really like the model of, moving from buying in shops to online. We think that is going to continue. And a lot of it's to do with these digital platforms. They have wonderful CRM platforms. So once you've plugged in, they tend to get you as a recurring customer, because it's so easy to do a digitized card that's personalized, and you get the reminder popping up in your inbox. Oh, it's your uncle's birthday.
Yeah.
Here's a card for your uncle, and it's you think, oh, that's perfect, £2.50. I'll have that. And it's just so easy. And then you've got the attachment of gifts is the other big one, where it's so easy to attach a box of chocolates or a bunch of flowers, if whatever it is. So we just like that platform. They've got a 60% market share in the UK.
Yeah, they seem to have been the go-to provider now, and they seem to, once you get that platform, that solid brand, it's like anything. It's like Amazon. It's just impossible to break in that particular market for competitors. Huge barriers to entry, particularly as much more on the internet when you come to searching and stuff. Nobody's got a big enough marketing budget to be able to unsettle them.
I think what impressed me was just how it had moved on in the last 10 years, because there were quite a few companies around trying to do this sort of thing 10 years ago, and the technology just wasn't good enough. But I think, Moonpig really have moved up to another level. And I think as a result, you're likely to see, the online penetration of cards continue to grow, and they will be a big beneficiary of that. And, again, that owning the customer, if you like, on your digital platform is so valuable in terms of then driving future e-commerce type business off it. So we like the long-term potential there. Will there be a bit of a slowdown as we unlock and people go back to the shops? We've seen amazing results from the clothing retailers like Next, haven't we, where you've got big like-for-like growth in the stores because people have rushed out and started buying clothes again because they're now going out of their houses having sat there scruffily in their t-shirts on the sofa for a year. So you wonder whether there will be a little bit of, there may be a bit of a slowdown, but we think that's broadly captured in the forecasts in Moonpig. So that's one we like. Yeah, it's a good idea.
Yeah, and there's a couple of fallen angels which look quite interesting you've got in your portfolio that I know investors have had a look at. Are sort of like this Blue Prism and Clinigen. If you want to start on Blue Prism, which I understand is a sort of like a software automation robotics business that helps large companies assist their management teams and employees by effectively doing a lot of the repetitive work and to improve sort of teamwork and just bringing that whole AI and automation into jobs that frankly should be done by machines rather than employees.
Yeah, that's right. It's think about it as automation into the white collar space rather than the blue collar space. So robotic process automation, the RPA market started to grow very strongly a few years ago. And Blue Prism IPO'd on our market. They were one of 3 big players in the space. UiPath were one, AA was another one. And you're absolutely right. It was mainly the big insurance companies and back offices of the big financial institutions who were wanting to automate, repetitive tasks. And this RPA software was a terrific growth area for getting productivity improvements in those financial services. So we actually invested in Blue Prism when they IPO'd. 6 or 7 years ago.
That was about £1.60, wasn't it?
Yeah, well, I think we made about, I don't know, 5 or 10 times our money.
Well, the shares went up.
We took profits along the way. We did actually sell out and then we sort of bought back in because the valuation got very high. Once anything gets up to sort of 10 times sales, I'm always a bit
okay. Smart move.
Very hard to see how you're going to grow into that multiple. So in truth, we did actually sell Blue Prism about 3 or 4 months ago. And there were a number of things. So we had a very small holding, and the reason was there were a few risks that we didn't like. There was an issue around how they were incentivizing their sales force and growing their sales force that we were a bit uncertain whether they were going to be able to keep doing it in competition with these very well-funded competitors over in the US in particular. So we had a few question marks about their ability to continue to grow their sales force and retain it. We also had a few issues around the way that the share issuance was going on and how that was being captured in analyst forecasts. We saw a couple of errors in analyst models where they weren't capturing the dilution, and we thought the market was missing that. So as a result, we'd actually downweight, even though we really liked, in many ways, we liked the company, we liked the RPA market. Those gave us pause for thought. The final kind of, unfortunately for us, the thing that really killed it for us in the end, and we might be proved wrong, and maybe I hope we are for the other Blue Prism shareholders out there, but was Microsoft entering the market. They announced in March. They call it RDA, which is robotic desktop application. I think it's robotic desktop. Robotic desktop automation. Sorry. And the reason we're worried about that is because the way they were talking is they're going to basically attach this to Windows 10. So anyone who's got Windows 10 is going to get these RDA products onto their desktop to help automate their own workflows. And they were then talking about developing quite a few RPA, robotic process automation products as well. And I just looked at that and went, crikey, it's one thing competing against 2 private equity funded US players, but if we've got Microsoft now coming into this market as well, all those things that we were worried about in Blue Prism are now going to come under even more pressure. Now, hopefully Blue Prism proved me wrong, but that's why we've come out of the share actually. So we don't actually own that one anymore. Okay,
well, you've done pretty well anyway. It's sort of like at least probably 4 or 5 times your money. So it can't be a bad trip once you've sort of come out. What about sort of Clinigen, which again has sort of fallen over a bit just recently? It does sort of like 2 things. It's got a products division and a services business. The services business sort of supplies sort of clinical trials and comparative drugs and other sort of like maybe off-license type of drugs into healthcare professionals around the world. But the products business is where they actually really suffered with Proleukin, which is I think it's his first generation immunotherapy for skin cancer and kidney cancer treatments, and they've really struggled, and because there's been very few elective procedures over the last 18 months, and it's really, how do you see that one going forward?
Yeah, I mean, again, we've got a very small position in that one.
Oh, is it? Oh, okay.
Yeah, and we used to own a big position in it, but there's a few characteristics of it. First of all, the services business is quite volatile, very hard to forecast, and as you rightly say, because of a lot of elective procedures and a lot of therapy have been postponed, that certainly impacted that part of the business. So that's moved around quite a lot. But the high gross margin, the high value added, is the other area, which is where Proleukin has had a few issues, and there's been a few delays. So we had, fortunately, only a very modest position in it, and obviously it took quite a dive, didn't it? A couple of months ago, it sort of fell 20%. I mean, that's not the kind of dive you want to see in your portfolio when you come in the morning. The kind of dive you want to see is Tom Daly and his partner, Matty Lee and Tom Daly. What a dive that was this morning.
Yeah, you're right. Yeah, get the gold medal.
That's the kind of dive you want in your portfolio, not a Clinigen down 20% when you come in the morning. So it was a bit disappointing to see that, but I think we're still, we are, modestly bullish on this one. We think there is obviously a lot of potential in Proleukin, but the problem is you've got quite a leveraged balance sheet now. Yes. You've got a lot of volatility in that services line, which is difficult to predict. And yes, there's an interesting pipeline there, but it feels like we're a bit too close to tossing the coin than I'd like to be.
Right.
We're not a big. I would say in terms of our investment process, one of the things we try and avoid is catching falling knives, and indeed fallen angels is not something we specialize in. I would say that you tend to stay away from fallen angels as a general rule. The only time we get back into those is after what we call a long recovery period, where they've been out of favor for many years. Investors really don't like them anymore. All the growth investors have come out, and we will buy recovery stocks in our portfolio. And they're really interesting, and you get great opportunities to buy recovery stocks like the general retailers last year, DFS.
Yeah. But let's move on. Let's move on to those then, because you've got some really good ones which have done well. What about Photo-me, which has been around for years and used to do photo booths, but they seem to have transformed totally into sort of like an end-to-end type of sort of remote services business, and they do sort of ID, obviously, photographs from their photo booths, but now into sort of like vending machines for food and also for numerous other things. But it's sort of like clever now servicing, isn't it? Which they've moved into, which is really transformed their business model.
Yeah, it's really interesting, Photo-me, because you look at it and you think it's, you think about the Photo-me booths and you just think, what?
Yeah, I thought it'd be dead and buried this.
Yeah, and you just think, well, surely that's out of date.
Old technology. Why would you want to own that? The amazing thing about it was such a cash generative model. They had a strong balance sheet. They always generated loads of cash. And as you say, they were recycling that cash into some new growth areas. They were doing the laundry as well, isn't it?
Yeah, the laundry mainly in Europe, but in the supermarket car parks, the laundry was growing nicely. They had the ID business, digital ID business, which was also growing quite nicely in Asia and in Europe. And so they did diversify well. We're growing very nicely, but of course the pandemic absolutely hammered them, because suddenly you've got no one in train stations, no one in airports going and taking the photographs in the booths, even going to the laundry, the less people. So a fixed cost base that they had to very quickly cut costs, which they did. And in truth, we looked at our portfolio as the pandemic was unfolding and managed to exit a number of high fixed cost consumer facing businesses quite successfully. One we weren't able to get out of was Photo-me. There wasn't enough liquidity. So well, we've got it, we're in for the duration. One of the interesting things is Serge, the CEO, has constantly bought stock right through the whole pandemic. He now owns 28% of the company. He's been hoovering up stock, so he's really confident, and it's been an impressive cost-cutting exercise. They are shutting down booths all over the place. I can't remember the exact numbers, but they've taken out thousands of booths. So they've got great data on all their booths. They know exactly which ones make them the money and which ones don't make them the money. So all they've done is they've literally shut down, like a third of the portfolio in the UK. I think they've shut down 1,000 booths in
lots in China as well.
The Chinese capacity they've taken out. They've taken 1,000 out in Europe, or I can't remember, but they've taken out enormous amounts of capacity, cut the cost, enabled that cash generation to continue, and I think they're really well positioned now as the economy opens back up to then recapitalize. So to some extent, we're in that one out of good fortune in a way that we got stuck in it, and we're quite excited to be in it as we come out the other side.
Yeah, the operating leverage will be massive because they've used it, haven't they? That classic expression, don't waste a crisis, and they've massively changed their cost base. and they've moved into growth areas of, as you say, remote monitoring, vending machines, and also these unmanned laundrette type of operations, which is frankly where the growth's going to be.
Yeah, no, absolutely. We think they're well positioned, strong cash. I would hope that they'll start paying a dividend again soon, and we'll be off to the races.
Yeah, another one which is a sort of consumer, which is perfectly placed is DFS Furniture. Now, my wife has been trying to get a flipping sofa or a settee, and it's just impossible. And these guys is not surprised because their demand over the last few weeks has just rocketed as people have been allowed back into stores and been able to sort of like look and feel and test and see how comfy these things are. They just want to buy, and these guys seem to be knocking the ball out of the park now.
Yeah, I mean, it was sometimes investment's quite simple, isn't it? And I think recognizing that lots of us are going to be stuck at home on our sofas and we'll probably keep buying sofas. Was an early thought, for us back in sort of April last year, and then they refinanced as the market leader. And we always like market leaders who, a sensible management refinancing to get themselves through a crisis, and that's what they did. They were 30% market share in the UK. So we knew that some of the competitors were in a difficult space, and actually Harvey's went bust, I think, in June last year, one of the big competitors. And that's what you see with these, what we call cyclical survivors. They can take market share. And one of the big advantages DFS have got is this vertically integrated supply chain. And it's much more onshore than many companies already. You hear about this onshoring from China now across many industries. Are we going to be, after the whole PPE debacle, are we prepared to outsource all our manufacturing to China? Well, a lot of industries aren't going to be. We're going to see this reshoring process. Well, DFS are well down the line on that. So if you think about a sofa, being shipped in the past, you might have had your leather coming from Latin America into China, put onto a sofa, then shipped across to the UK or Europe or America to be sold as a sofa. That's not very eco-friendly. It's not very sustainable. It's very expensive when you get disruption in the world economy like we've had. So the great thing about DFS, they've got operations in the East Midlands, they've got Eastern Europe, they've got quite a lot of manufacturing and operations, and they've got a really good sustainable agenda. So they're making lots of the cushions with recycled microplastics, not foam. They're really thinking about the recycling of 90% of old sofas go to landfill. I mean, that's shocking when you think about it. You think about how much space you're filling up in the ground with old sofas. So they're really focused on these issues. And as a result, it's great for the brand. The old brand of, it's just a bunch of credit-driven cheap sofas, I think is moving away. And they've taken a lot of market share. They're now up to 36% market share in the UK. Wow. Moved on again. So really nice story there where, the brand is improving, the market share is increasing. And that's when we're buying a cyclical recovery stock, we always try and look for some kind of structural tailwind as well. So it's not just, the economy's rebounding, we'll play it. It's what else is going to drive it on to become the next growth stock that people then re-rate. And that's what we try and look for. And it's a good example of that.
Yeah, and also I think on top of that, you've got a lot of people now working from home, building their own home offices. So you've got probably at least 2 or 3 years until, of people basically thinking, right, okay, I'll have a sofa in my home office, or I'll make my house a bit nicer and all that kind of stuff. So they should do.
So you can have a snooze early afternoon.
Exactly. That fridge you haven't been able to get, you can have it next to a sofa when you can get it as well. Now another one which is again reopening, but has also come through the pandemic pretty well, is Halfords. Obviously, it's done very well on the cycling front because everybody and his dog's been out on the road, particularly whilst there hasn't been any cars, which is fabulous. But what was really interesting, I mean, I always thought Halfords was sort of like batteries and exhaust and that kind of stuff. But they really now seem to have transformed into a more of a, rather than just a straight products business selling parts, car parts and stuff, they're now into a services business and have got lots of mobile service guys. So when your car doesn't work, it doesn't start on the drive, they can come and help fix it, a bit like the AA as much, and bring the parts.
It's a great service. I've used it, Mobile Expert. You're absolutely right. It used to be the case that Halfords started doing, helping you out, putting your windscreen wipers on when you went into the car.
Yeah, that's right. Yeah.
Then it was, put your roof. If you're a Wally like me, you can't get your roof box on straight, so you can get. I can actually do it on my own now, by the way, just so you can.
Oh, okay, good. Yeah.
When I first did it, I went to Halfords, and the first time I put it on the roof, I was like, "Can you help me put this on? I don't want it to fall off. It's going to."
Yeah.
So they put the roof box on. Now you're right. The services has really expanded. They've got the Mobile Expert service. I got a puncture a few weeks ago.
Yeah, tyres, whatever.
You know, and I had one of these mini compressors in the car and blew the tire up enough to get myself home, and then called out Halfords, and they were brilliant. They came around, really expert, branded van. He just changed it over, good as gold, pretty cheap, great service. And I just thought, wow, well, that's you know, way above where my old sort of understanding of quick fit, or
it was
or a lot of these AA services and breakdown services where you were like, do I call the insurance company first? Do I get it? You know, it was all just quite difficult to get it organized or to do it cheaply. And I think Halfords are just really, because they're with the, you know, they're right at the front end with the consumer again. I've got a real opportunity to grow that services business. And there was already a good self-help story that we'd bought into, which was around, you know, gross margin mixing up and cost cutting. Anyway, so, you know, 80% of it is obviously car maintenance, 20% bicycles. The only worry at the moment, of course, is getting bicycle parts and bicycles into the country. And the waiting list on some of this stuff is off the chart.
Yeah, well, I mean, but yeah, that will come through. It's a matter of when they're going to get sales rather than if. But I do love that whole services one, because I think what investors and even the industry may not have yet fully twigged is actually the reliability of electric vehicles, and whether that's a scooter, whether it's electric bikes, or your Tesla or whatever it is, you know, your electric car is shocking compared with your standard diesel. I mean, because obviously it's got so many things which can go wrong. And if you've got basically a nationwide coverage of a top lot of trained auto mechanics in electronics, I mean, even my local, you know, guy who does the garage fitting of a petrol car, he can't fit most of the electrics, because you need the, you know, the diagnostics and all the expertise. If they do that, they could really knock the ball out of the park as people migrate towards electric vehicles.
Yeah, there's a very decent opportunity. They have re-rated to some extent over the last year or so. Obviously, the shares have done very well, but the reason we've stayed with them is that the forecasts have been conservatively set constantly. You know, analysts have tended to be behind the curve, management have been conservative, and that's what, you know, that's what keeps us in shares running those winners where we know there's going to be earnings up, or not know, but, you know, we're confident in the earnings forecast upgrades in the future. That tends to keep shares moving in the right direction.
One of them, which is moving on to another share you own, which is sort of like a digital, we'll say online real estate, is On The Beach, which has got a large, you know, sort of presence in sort of like package holidays for Brits going abroad and stuff like that. And they've been obviously frustrated as we've had lockdown after lockdown, as they thought they'd get going, and you know, they've come through it. What's your view on that one so far? Because I've obviously got a good brand, and it's a matter of sort of getting through it, and then you should get that huge pent-up demand next year.
Yeah, we're certainly in the camp believe that, you know, staycations are booming at the moment, but they won't be a permanent shift. One thing that won't change in this country is the unpredictability of the weather and the overcrowding of our beach resort. You know, I know I've just been down in Devon myself. It was unbelievable.
Busy, was it?
Gridlock down there, you know. But still beautiful part of the world, but don't get me wrong, but very busy. So our view is that people will, once their confidence comes back, we will get back to flying abroad quite regularly. Most people will get back to that. We don't think that will change that behavior. People still want to explore the world and have holidays. So we like, again, that digitization advantage, a pure digital platform versus the old TUI, you know, even Jet2. I mean, Jet2 is a big improvement on TUI in many ways in terms of that fixed cost base, but On The Beach have great flexibility in their ability to market. You know, they decide, and they just decided a couple of months ago they weren't even going to sell holidays for a couple of months because they had so much uncertainty with the government. They didn't want to damage the brand by selling holidays and then having to stop those holidays. So they actually said, we're not going to sell any through to the end of August, I think. So they've actually done a couple of fundraisers. The last one, we don't think they need to do. It was very conservative of them to do it. They did a small placing to boost the balance sheet. But again, it's just, they've just got this very strong digital platform where they're constantly getting great client information, and we think they'll continue to take market share. And there's a number of regulatory changes as well around things like customer deposits and ATOL and these things, which we think are going to disadvantage some of the incumbents and help players like On The Beach. So there's quite a few quite nice structural drivers so that when the cycle comes back, there's no reason why they shouldn't then go and take market share and do very well. So they're well funded. Good management team, great innovation again. And yeah, it's just a nice way to play the reopening trade, as we call it.
Yeah, well, again, it's almost like going full, you know, come back to where we started as much as anything, because if we do get the vaccination rates higher across the world, in line with, say, the UK, and we have the medical tools to be able to sort of like deal with it, most of the new variants, then they could actually see demand massively increase for winter sun over the December and January, and then really next year could be a total boomer, no doubt about it. Now, just on that, on going full cycle with inflation, you've got some really nice stocks with pricing power that seems to be doing really well, particularly in the sort of construction and infrastructure. You've got Tyman, which does sort of doors and windows, that seems to be doing very well as new build houses have happened. You've had also the brick boys, Forterra, who are selling all their bricks and can't get enough of them, I think. And then you've got the new guys. They used to be called Polypipe, but now called them, rebranded and called Genuit. Do you want to take us through those? Which I think they do sort of like I can't remember what they obviously pipes, don't they? Drains and pipes. It's in the name.
Yeah, I mean, they're all obviously all construction companies, but in some ways all quite different. And particularly, Tyman and Genuit Group have got quite a strong sustainability agenda as well, which is enabling them to take market share and gives you some regulatory sort of tailwinds, which helps the growth. So it's not just a GDP growth play when things rebound. Tyman, let's start with Tyman. You're right, it's mainly a doors and windows manufacturer and to some extent a distributor. 75% of the business is in the US. Most of their employees are in the US. But, again, it's very geared into sort of volumes of houses. It's not too tied to pricing of houses. And obviously, we've seen quite a boom in house prices, haven't we, across the world over the last year.
Huge.
But this is more to do with the volumes. And again, it's a good example where you've got an innovative company and you think doors and windows. Well, that sounds a bit commoditized, but Tyman have got nearly 500 patents on the technology they use within their doors and windows. And they've got another 150 odd outstanding patents pending at the moment. So tremendous innovation there, which enables them to, put their design engineers working with their big customers to develop, different products. And that's the sort of thing we really like to see because, again, it enables them to take market share, really cement those big customer relationships. And in a highly fragmented market, that gives them quite an advantage where they can then consolidate the market as well, pick off the smaller players, buy them quite cheaply and wrap that up. So there's an element of kind of construction recovery, which you're playing, but you've also got this quite nice overlay of the innovation, which is driving the underlying growth and consolidation.
Yeah, I did see actually, just on there, they had a strategy update, didn't they? They were saying that basically they're looking toward targeting higher operating margins going forward as a sustainable level. I'm guessing that plays to your innovation because and also a lot of self-help. I mean, again, if a company's got through the pandemic, it's in a much stronger position competitively than its rivals, and therefore the winners could win really, really well as we move forward, which seems to be the case with Tyman.
Yeah, we've been watching as we've seen obviously the threat of inflation over the last 12 months potentially coming through in different industries. One thing we've been watching like a hawk is the gross margins and how companies are coping. Sometimes it's quite difficult. A lot of the companies, even though they're small caps that we invest in, are quite big companies with different divisions, with different gross margins. You get business mix shifts, which make gross margin forecasting sometimes quite difficult. But putting that aside, what you're looking for is companies being confident about pushing through cost inflation through pricing. And I think, Tyman's a good example of one that's managing to do that at the moment and is confident they can push that, some of it temporary, but not all of it cost inflation through into the end market. So that's really encouraging to see in terms of that pricing power. And then if we come back more domestically, you mentioned Forterra and Genuit Group, the old Polypipe. I mean, just starting with Polypipe, there's a couple of stories here. Firstly, the shift from old metal pipes to plastic pipes has been a structural trend that's been in place for Polypipe for quite a long time. But I think what's really driving the additional leg of growth now is things like the green urban generation and a lot of the policies coming out of government now to drive the decarbonisation of our homes and indeed industrial and commercial premises. So you hear a lot more about electric vehicles, but obviously the decarbonisation of our buildings is a massive thing now. And they, for example, they've got a leading ventilation business, bit like we've got Volution Group in the portfolio as well. But Genuit Group have got one of the leading ventilation businesses. And if you think about the new build homes coming down the line, by 2025, you're not going to be able to build a home with a gas boiler. So you're going to be using air source heat pumps, more underfloor heating. You're going to need great insulation. But if you have all of that, you don't want a stuffy home. You need really top top level ventilation as well. Otherwise, it's not a very pleasant environment to be in. And so you're going to have a big investment in ventilation going through.
Wow.
So if you've got one of your leading ventilation players who's now producing products for that 2025 legislation coming through, you're in a very strong position. And both Genuit Group and Volution are in very, very strong positions to capitalize on that growth trend. And these are when I was saying earlier about, you think about the big tech innovation waves that have caught people out to sometimes, because you can't believe how fast and how long these companies can grow for. We've integrated ESG into our process significantly over the last 12 months. In the part, we've done it in the past with buying in MSCI ratings and checking them and things like that. We've done that for a while, but I think we're much more focused on now the sustainability agenda and how that's going to drive opportunity in many of these companies. And I think the construction companies are really good examples of that, is picking the ones that are going to really benefit. Let me give you an example. Genuit Group are targeting 25% of their revenue from new products in 5 years' time. Well, for construction, that's unbelievable. Construction company, isn't it? If you think about it, their employee engagement's improving. They're doing all the right things from a governance point of view. That the way that the C-suite are incentivized, you're not just on total shareholder return and EPS growth. It's now on sort of ESG issues as well. And because you're going to get so much legislation and regulatory interference in industries around this space, you've got to be on the right side of it. If you're on the wrong side of it, you're going to get hit because the cost of carbon's going up. If you're on the right side of it, there's the opportunity to make money. But what we've got to avoid is paying for blue sky, green solar companies that end up, crashing on us. We don't want those in the portfolio. They might come right, some of them, but a lot of them won't. We want to find a bit like transitioning into a digitized economy with the old economy stocks. If we can find those companies that are going to successfully transition down this net zero targeting and decarbonisation, that's going to give us a tailwind, which we're really attracted to. So we've got some really great sustainable businesses in the portfolio at the moment.
It's a great point, that is, Dan. I hadn't appreciated. I do a lot of sort of like investor stuff, research and that kind of stuff, but I had not appreciated that whole legislative shift on ESG on the construction. And I love the idea in terms of sort of Polypipe and others who are going to benefit by, as you put in greater insulation, you need ventilation. That is really insightful. That is so.
Just one other small anecdote. We saw that terrible flooding in Germany a couple of weeks ago, and
I had it in London last night.
Well, that's what I couldn't believe when I came back. And one of my colleagues, unfortunately, had his house flooded in London, and had his baby. It was a nightmare for him. He had to move out with his little children and stuff, and he had those flash floods. But again, this whole drainage issue in London and in other cities, again, is where Polypipe are right at the forefront of resolving those issues for councils, etc. So they're working on solutions with architects, all the rest of it, to fix that sort of problem, and that's a great play for them.
Yeah, two other interesting opportunities just to run over are Allergy Therapeutics, which I think does sort of like it's allergies for it's kind of grass pollen and stuff like that, and peanut allergy. Yeah, that's what. And Aptitude software. Do you want to start on the old the Allergy Therapeutics?
Yeah, well, this is interestingly, when I invested in this, I didn't really suffer from hay fever much myself, but I've had a terrible bout of hay fever this year.
Yeah.
It really knocked me out for a few weeks, and so I've got, again, a lot of sympathy with the customers. But Allergy have got some great grass allergy technology and tree pollen therapeutics, essentially. They've also got in the pipeline a peanut allergy medicine that they're working on as well. So they've got a number of different pipelines, if you like, of different medical technology. And overall, we just see it's been quite an undervalued share. It's just not had there's been nothing in the valuation for the future.
You're right. It's about one. I was looking at it. It's EV sales is about 1.8, and they're well cashed up. So if they can get this to normal sort of medical healthcare margins, then it'll be an absolute gold mine for investors.
There's been a few issues in the last couple of years, particularly recently, because a lot of things like the pollen trials got delayed because of COVID, and so there's been a few issues around it, which has made it a bit. You've had to be patient as an investor for sure, but we still think it's quite undervalued. We think some of the they've got I haven't looked at it for a while, so I won't get this as accurately as I could, but they've got some really good short cycle treatments. So many of the sort of hay fever products.
Well, they make sales of 85 million.
They're just not that user friendly, and they've got a really user friendly product that's very effective. And it's just it's taking market share in Europe. We think this is just, is a market that's growing all the time. More and more people, unfortunately, are suffering from hay fever and similar sort of illnesses. So we think there's some of the parts we still think we're looking at about 45p.
That's the same as FinCap. They've got about 45p price target.
So FinCap and Panmure's cover it, and they've been quite conservative, but they've been very sensible in their forecasting. We think overall, we've constantly looked at it and thought actually they're being almost overly cautious on some of the cost assumptions here. And we think one day that sales growth will translate into quite significant profits and cash flow for this company that maybe isn't in the price yet. So.
Yeah, and Aptitude software seems to be sort of like one of those niche software, but dominant in their sectors that provide systems that help finance and operations, that whole digitization of back office, and presumably they're going to do well going forward, as we've now digitized the front communications, the Teams and Zoom as we're on now, and then in most businesses now want to do their second tier and third tier back office systems, and these guys, they're streamlining efficiencies, allowing people to work from home, I guess.
Yeah, it's really helping CFOs really, as you say, one, digitizing the way they do their accounting, but also it's helping them cope with the constant flow of regulatory change. If you think about IFRS 16, there's been the delayed IFRS 17 this year. These new regulations around accounting standards, I should say, coming out, cause constant complexity for CFOs and businesses. And I think, any product that can help them through that, as well as achieve that digitization, really good, a dashboard of information on their companies is worth having. And Aptitude have a very, very strong suite of products. Again, lots of R&D going, and they spend a lot of money on R&D. So the product development cycle is very interesting. So again, short term, we haven't been aggressively playing it because there's certainly been a few wobbles in the numbers. We've felt that underlying, we think there's a very strong revenue story there that's going to translate into strong profits, but in the short term, the profits haven't been quite as strong coming through. But we think it's a great product set, and I would say, the recent drift off in the share price is looking very attractive, potentially to present us a new opportunity to reload. But we still own it. It's a really interesting product set.
Good. And what just top level, sort of what risks and worries should people have? I mean, it seems to be now centered on China, having the announcement this morning that it was going to basically decimate all its online educational sector. And it's also been hugely into, obviously, stopping some of the big digital operators, the likes of Tencent and Alibaba and this sort of stuff. And that seemed, and obviously they seem to be pulling back from a lot of helping out their state-backed businesses, which, through their subprime debt, that there could be a blow up there. What sort of risks, top-level risks, are you sort of watching outside of what we've already talked about in terms of the COVID and variants?
Yeah, undoubtedly one of the lead indicators we keep an eye on is the credit impulse from China, and we saw that go sort of roll over early on in spring.
Hugely.
And then it went negative, and that was definitely a lead indicator. It tends to be a very strong lead indicator for Chinese activity, the metals prices. And there's something we've been watching. And of course, in the whole long duration tech sector end of things, one of the things that obviously we've all been focused on, what's going to prick this? Maybe it's going to be more taxes. Maybe Biden's going to, come in and disrupt the US tech. And of course, what's actually happened is it's China who's really got aggressive with their own tech companies and started thinking about taxation, regulating that space. Really interesting dynamics at play. And I think you have to watch all of these things. It's never easy to decipher it, but it did. Again, if I just go back to that sort of peak in inflationary expectations that we had 2 or 3 months ago, there was probably a peak in growth expectations, as you say. We're watching. There's some very strong nominal GDP growth coming through in developed markets, as you'd expect. But interesting, some of the strategist forecasts have been drifting off the last 2 or 3 months, and they might be coming from 9% to 8% nominal GDP growth. And you think, well, that's still really strong, but the market tends to react to that derivative, that change, that rate of change of growth. And so we're certainly watching that. So it's going to be interesting. I mean, as I said, I think in the UK we're pretty well positioned because of the way the pandemic's played out, because of the vaccination program. I can see this wave coming off, and actually that there being some pent up demand, certainly in the consumer end, and us doing reasonably well. That said, you never know how the market's going to treat sterling with all the debt we've got, like other currencies, and so you have to have a balanced portfolio. The nice thing about the small cap market, bit like the large cap market, you can get lots of overseas earnings in your portfolio as well as domestic earnings. So we don't take a big bet on that versus benchmark. It's about 50-50 in the portfolio.
That increase in sterling will certainly be helping your retailers like DFS and the other guys who may be buying some stuff in from abroad, because it's going to help their margins, isn't it? So that's quite a nice little kicker for them. It
is, but I think we've got to be careful not to be complacent about sterling continuing to increase in value. It may well not, it may drift off, and even we've seen it drift off against the dollar a little bit, haven't we? Gone from 142 to 138. So, so again, we tend to take quite a balanced approach there. We want those top domestic companies. I mentioned Genuit, but we've got Tyman that balances that. It's all US dollar exposure. So you're trying to balance that in the portfolio the whole time, to manage that. As I say, the lovely thing about small cap world in the UK market, you get these great businesses IPOing and coming through, and there's always opportunities. It's still a very deep stock market, and there's lots of good value still out there. So I do worry about some of the sentiment in the US. That it's very hard to see what's going on, but it does look very frothy still, and I mean, I know Bitcoin's fallen a bit, and I know we haven't heard about the Robinhood investors quite so much, but some of that froth, you do worry at some point it's going to create a bit of an issue in the markets. But then we've been saying that for years, haven't we?
Yeah, true. So. Oh, all right. Well, brilliant. Well, thanks very much, Dan, for your time. And I'm really looking forward in 6 months' time to touch your base again. Because I want to hear where you've been deploying all the acquisition funds you're going to get in. So you've done. I mean, obviously the portfolio's done really, really well. And you're well positioned, just what we've chatted going forward. And I'm with you. I think top level, the markets are pretty. I mean, they're going to see some volatility, but there are lots of companies. If you choose the right spaces, there's lots of opportunity out there. Yeah, there's lots of gold medals to win out there, both in the Olympics and in the small cap world, for sure. Well, I think you've just earned one yourself. So take a bow. Okay, well, it's not all me. I've got a fantastic team around me, as you can appreciate, with George Ensel helping me on the fund, and all the analysts, so and everyone else around it. So it's been we've had a good year, but there's lots more to do. Well, looking forward to that. So thanks very much for your time, and speak again probably in the start of next year. So thanks, Dan. Cheers, Paul. Thanks. Bye.